So a knee-jerk reaction would be to buy the dip, and that may end up being the right thing to do. But all right, welcome to Talking Investing. I am Tom, and as always, this is not financial advice. Today, I want to talk to you about Netflix, kind of an emergency video here. Netflix is crashing as we speak. So for those of you who are new to the channel, please subscribe and hit the notification bell, and everybody, please smash the like button. It helps the channel out a lot. I want to talk about Netflix. They reported earnings after hours yesterday, and it was a catastrophe. I want to dig a little deeper and see what actually happened, because their earnings were actually good. That was not their problem. They have a specific problem, and I want to dig into it and see what they can do about it and what it means for the stock. Netflix is currently trading at $226. It's down 35% today. So Netflix got decimated at the last quarterly earnings 3 months ago. It was down 20 or 25%. It was already significantly off of its highs of 700 back in November of 2021, which was just 4 or 5 months ago. And now it is getting destroyed from that level. So we're down 35, almost 36% now as I'm talking. So it's early in the day. We'll see where this all shakes out, but it does not look good. It's breaking a 3-year line of support as we speak. And if it breaks below that, who knows where the bottom is. I want to go look at their actual quarterly results and talk about what happened. This is a letter to the shareholders, April 19th, 2022. So again, this was after hours yesterday this was issued. Fellow shareholders, our revenue growth has slowed considerably as our results and forecasts below show. Streaming is winning over linear as we predicted, and Netflix titles are very popular globally. However, a relatively high household penetration, when including the large number of households sharing accounts combined with competition, is creating revenue growth headwinds. So right off the bat in the first paragraph, they talk about households sharing accounts. So I'm going to get to that later. This is a gigantic problem for them. When you look at the numbers, you're going to see they actually beat on earnings. So this is not an earnings thing. They just missed on revenue, but not by much. Where they had their gigantic miss was on new subscribers. So just quickly to show you, this is the last 5 quarters. So quarter over quarter since quarter 1 of last year, they had growth in quarter 2, they had growth in quarter 3, they had growth in quarter 4 of 2021. This is quarter 1 of 2022. So you can see they still did have growth. They just fell short of their forecasted growth. So they continue to grow on the top line. They continue to grow on the bottom line, but that is not what is driving the price action today. Before I get into the details, I want to put things in perspective. Netflix has 222 million paying households. So that is their user base. So as we talk about all these numbers, we got to keep it into the perspective of they're already at 222 million households using this. The second thing they say here is we estimate that Netflix is being shared with over 100 million additional households. So a third of the people watching Netflix are sharing with somebody else's account. That is a massive, massive number. Okay, so then they talk about competition. Competition for viewing with linear TV as well as YouTube, Amazon, and Hulu has been robust for the last 15 years. However, over the last 3 years, as traditional entertainment companies realize streaming is the future, many new streaming services have also launched. While our US television viewing share, for example, has been steady to up according to Nielsen, we want to grow that share faster. Higher view share is an indication of higher satisfaction, which supports higher retention and revenue. So just quickly going to look at this chart. So you can see this chart is of US TV viewing time. So from a streaming standpoint, they're still holding their position as the leader at 6.4%. YouTube, which is owned by Google, is at 5.7%, Hulu at 3%, Amazon Prime at 2.3%, Disney at 1.7%. So you can see they're well ahead of their other direct competitors, and then 9.5% all other services. So as we look at some of the bad numbers ahead, I just want to keep in perspective, Netflix still is the giant in this sector. And I'm just trying to hit the highlights. This is a 12-page letter. Another focus is how to best monetize the $100 million households using another household's account. So these are the 100 million users that they have that are using somebody else's account that are not paying anything. So they're saying this is a big opportunity as these households are already watching Netflix and enjoying our service. Sharing likely helped fuel our growth by getting more people using and enjoying Netflix. And we've always tried to make sharing within a member's household easy with features like profiles and multiple streams. So sharing within a household is okay for them. It's the 100 million households that are using somebody else's account that they're trying to monetize. So what they said is they've introduced 2 new paid sharing features where current members have the choice to pay for additional households in 3 markets in Latin America. So these are test markets. They have not launched this worldwide. So essentially, I assume they're offering some level of discount for additional households versus what they're getting paid right now, which is 0 on 100 million households. So I don't know how effective that's going to be. They have several other strategies they talk about to try to monetize through potential advertising, which would be totally new to Netflix. Netflix is advertisement free. So one of the ways to capture revenue on these households that aren't paying is to have some of their programming contain advertisements. So I don't know that they're going there yet. I'm not sure they know what they're going to do about this. I think this snuck up on them. They were forecasting 2.5 million additional user growth in this quarter, and that did not happen. So I think they are right now realizing this problem hit them faster and harder than they expected, and they're bouncing around ideas. So it is yet to see what will come of that. So let's get to the actual problem. Okay, so they did increase revenue, but let's get to the number that counts, because you'll see operating income of $2 billion was above our beginning of the quarter forecast of $1.8 billion. So they made $2 billion in this quarter. So it's not like this company is failing. You can see their revenue number was great. Their profit number of $2 billion in a quarter is great. It beat their own estimates. So that's not what's gone wrong here. So let's get to it. Paid net additions were negative 200,000 compared against our guidance forecast of positive 2.5 million and compared to 4 million in the same quarter a year ago. So this is where things have gone sideways for them. They were expecting 2.5 million additional new paid users this quarter. The same quarter last year they had 4 million. So these are the types of numbers they're used to. This is an ultra high growth company, and it has been. That is why in the past it has traded on such very high valuations. So this is the first time in 10 years they have now had a quarter where they actually had a decrease in the number of users, and it was a decrease of 200,000. Now I will tell you that is a tiny bit misleading, and here's why. The suspension of our service in Russia and winding down all of Russian paid memberships resulted in negative 700,000 paid users. That is not a business as usual event. That is a one-off event. So not including those 700,000 users that they just basically turned off, they would have actually gained 500,000 users in the quarter. So I do think it's important to understand that technically, really, I view this as a net gain of 500,000 users. However, that is still very far short of the 2.5 million users that they were expecting. But that's not the bad news. The bad news comes in their forecast. So they say, as a reminder, the quarterly guidance we provide is our actual internal forecast at the time we report. For Q2 2022, which is next quarter, we forecast net paid additions of negative 2 million users versus positive 1.5 million users a year in the same quarter last year. So negative 2 million users. That will clearly be their first massive downturn in users. And again, to put it in perspective, they have 222 million users. So losing 2 million users does not really change their world drastically, other than the fact that it changes them from a high growth company to a company that is shrinking in users. So what they need to get to the bottom of is this a 1 or 2 quarter short-term trend, and they're going to have to convince shareholders that they are a growth company, because again, they trade on high multiples. Although with today's price action on top of last quarter's price action, they're now actually coming down to some more realistic price to sales and price to earnings ratios. So again, for me, out of everything that happened here, there is one thing that's driving this downward pressure today, and it is this forecast right here. We forecast net paid additions of negative 2 million users. So if we do a check real quick here, they're now down 37.5% to $217 I want to go look at the chart and show you what that price level means, because they are breaking a very long line of support right now. Okay, this is Netflix chart on the 1-day time frame. So you can see this was last quarter. You'll see this E right here for earnings. So they had this giant drop off last quarter. They actually recovered a little and went sideways, but going into this quarter's results, they were actually about 12% lower than they were after this crash from last quarter. So this has been a cascading down effect. You can see it was only here in mid-November of last year, about 5 months ago, they were at $700. They closed yesterday at $348. They announced earnings after hours. You can now see this is their candle today. So they opened with a gap much lower, and they've been going down all day. This red line right here is a 3-year line of support. So they are now breaking through this red line. It looked like at the open, maybe it was gonna gap down to this line and hold, and that line is at about $232. They're now at around $218. So the rest of this day is gonna be critical. If they can't hold this line, and I'm gonna zoom out a little bit, this is Netflix on the 1-week time frame. So you can see this line of support goes all the way back. It touched this line of support in December of 2018. That's 3.5 years ago, but it did not break this line of support. It initially created this line of support in January of 2018, which is over 4 years ago. So now at this point today, intraday at $218, this stock is at a 4-year low. So this is a catastrophe, because you can see if I zoom out a little bit more, really the next line of support is somewhere down here in the 180s, and then it drops down to around 150. So depending on what happens today, there's potentially a lot of downside left in this stock. They are now down just under 70% in the last 5 months from their all-time high in mid-November. However, we have seen a lot of stocks that get taken out once this downward spiral happens, particularly once they get below what is a 4-year line of support. This is now officially absolutely a falling knife. If it can catch itself at this line of support here by the end of the day today or tomorrow and reestablishes this as support, then I think we'll be able to make a judgment going forward from there. If it can't, 185, 150, these numbers are all potentially on the table. So a knee-jerk reaction would be to buy the dip, and that may end up being the right thing to do, but I'm not ready to buy yet because, again, I want to see if this situation stabilizes. If it does stabilize, I'd rather buy them when they firmly reestablish this as a line of support versus below this line in a free fall. So again, that's my personal opinion, not financial advice. I just wanted to show you guys what's going on with Netflix, because this is having ripple effects throughout the entire stock market. This is driving their market cap down radically. We don't know where it's going to end. I will say that a lot of other streaming services are getting punished today just in association with this Netflix trade. So I am looking at some of the other streaming services and potentially buying into some of them. And I will tell you the two that I look at most closely are Paramount and Curiosity, which is CURI. So again, I'm not recommending you buy those stocks either, but they are both down in sympathy pretty dramatically today. And I don't think their story has anything to do with Netflix story. So those are my thoughts on Netflix and streaming services. Hopefully this was of some help to you. Please remember to subscribe to the channel and smash the like button. Thanks so much for watching, and we will see you in the next video.